Greg Weldon joins me now on the line. Of course, the author of The Weldon Report, all sorts of stuff. This guy is, I'll tell you this, I'll give you the quick introduction. Greg Weldon is the guy other analysts follow when it comes to what's going on in the markets. He's got a depth to his research that saves an awful lot of time if you're an investor, because you know you're getting the real goods with him. Greg joins me on the line right now. Greg, I'm going to start with this. You were joining us. I can't remember if it was January, February, whatever. And man, I remember you telling us about gold, and you said, I think this is a place to be. You gave some examples, et cetera. Man, did that ever work out?
Yeah, Michael, it was actually early January, and we had started to turn bullish on the precious metals in November, late November, early December into January, and we wrote our gold and silver time to rise and shine was our Outlook 2016 research piece. And we basically said, look, I mean, this is a secular bull market. It had a 12-year bull run from 1999 into the highs around 2011. It had a very well-defined correction that was 4 years long, which, mathematically, it's a perfect 3-to-1 ratio. It was a 50% retracement of that bull move over that 12-year period. And interestingly enough, too, is when you dipped below the 50% retracement, you saw very aggressive accumulation of gold. You had many upside reversal days from just below that price level, which was below $1,100 an ounce. And we came to learn not too long after that in fact, the Chinese were aggressively accumulating gold at those levels. So for me, it was really kind of an easy call. And, we follow gold and we're known for our gold analysis, but we're not gold bugs. We're not always bullish on gold. We were on your show many times in 2012, 13, and even into early 2014, where we were, in fact, outright bearish. And we had, very blunt conversations about how you didn't want to own gold in those periods, where you were going to have a tremendous kind of almost generational type of buying opportunity, and that's how it unfolded. So to me, all humility aside, it was a pretty easy call, and it's played out pretty much exactly the way we thought it would. From here is where it gets really interesting, though, because maybe the market's a little bit overcooked in the very short term, and that's why we've produced another research piece here. What is the real value of gold in today's market? And just kind of looking at it from the perspective, at $1,300, is gold gotten expensive, or is gold still cheap? Is it value on a relative basis? And I can tell you, Michael, I'm as bullish on gold here as I was back in 2005 when I wrote my book, when gold was trading around $450 an ounce.
I also don't want to give people the impression that's all you do. I mean, you do excellent work on the stock markets, on exchange-traded funds, on currencies. There's a wide variety, and I'll get to some of that with you in a few moments. But I was talking with Michael Levy earlier in the show, and he was just sort of listing off. It seems like every week we've got another very big name in the investment business. This past week it was Bill Gross, again, talking up that you've got to have a portion of gold in your portfolio. Is that influential? Do you think once you start getting some big names sort of clicking into this, are they sharing their true thoughts? Are they, of course they've got so much money. I wouldn't want, maybe putting $100 million in gold isn't a big deal. Who knows? But I'm interested to see all of these reports coming out over the last, say, 6 months. And, it seems that every week there's another big name.
Well, I think it actually very much reflects what's going on in the background and what the driving force is behind this move in gold. And that kind of plays into where we think it is now on a shorter term basis, where speculators have piled in, and you might need to purge positions a little bit here to clear the decks. But you're going to have that type of buying underneath this market. You're going to have buying from a commercial account. You're going to have buying on we need a percentage of our portfolio in gold. And there's actually, if you really want to slice it all down, there's one very simple reason. When you have $11 trillion in sovereign debt yielding negative yields, I mean, they talk about gold is kind of people that don't like to invest in gold will make the argument that it doesn't yield anything. Well, right now it yields a heck of a lot more at zero than $11 trillion worth of government debt out there. So I think from that perspective, it's glaring how you do have this kind of need for safety again that the Fed removed when they were expanding their balance sheet for a couple of years there when gold was coming off. You don't have that now, and people are kind of seeing what's going on and, kind of thinking, hey, this is a little crazy. So they want to own gold. I think that's the right move, and I think that reflects, kind of the overall macro backdrop that we're facing right now.
Well, I think what your point is such a good one is that, my straightforward approach is money's got to go somewhere. Well, it used to be gold was in competition with, say, a 5% T-bill or something like that, the norm rate. Now we've gone to negative, as you say, on $11 trillion. Gold, there's no cost to holding gold any longer. There's no alternative in that sort of sphere that you go, that's yielding a lot better. I mean, look at the Canadian bond still hovering 10-year government bond around 1%. The U.S., whatever it is, it's under 1.5%. I mean, there's no competition anymore, or that big negative argument has now been removed.
Yeah, and what's happened, it's basically it's two. We kind of have two themes around that. One, of course, is the hunt for yield. I mean, you have people with liabilities on a long-term basis that are running out of stuff they can buy, and trying to meet those liabilities with some kind of return on capital here. You have to, and this is what the Fed wanted. This is what central banks wanted, was for investors to have to buy higher risking assets. In other words, to keep this whole thing reflated, they have forced people to, pay up for assets at a low yield that, you wouldn't have ever contemplated, where junk bonds might be here or some of these things. And for sure, it has caused, people to really step back and take a look. And you talk about Canada, Michael. I mean, this week's, and I don't need to get off track, but this week's macroeconomic data in Canada was glaring. You have a record trade deficit. You have the second lowest participation rate. It's the lowest participation rate ever, and the second largest monthly decline in full-time jobs since the crisis. You have a central bank that's already cut rates to 50 basis points. You don't have a heck of a lot of room there. And in fact, in a stealth way, and I'm not sure a lot of people even realize this, the Bank of Canada is expanding their balance sheet rather aggressively here. So they're kind of executing QE without really telling anyone they're executing QE. So this is a case in point to gold. If the U.S. is going to raise rates, what does that leave Canada with? So again, and when you look at gold in Canadian dollars is less than 100 Canadian dollars from its all-time high.
It's such a great point. I was hoping we'd get to that, is that, again, gold measured in different currencies. I mean, obviously, we always quote it in U.S. dollars, but I'd said a while ago that I thought the low was in Canadian dollar terms, even though I wasn't sure if it was in U.S. dollar terms. And look at this. We got the Canadian dollar was down a cent on that trade data you just alluded to, when they showed the trade deficit. I mean, it's incredible. And here we go again with the Canadian dollar. But again, that's why I think gold will be seen as an alternative here, because I think it's also essentially a currency play. Someone stands back and go, where am I going to put my money? Because I sure don't want the euro. I don't want the yen. I don't want much else other than the U.S. dollar. And so this has a place in a portfolio.
Yeah, and I mean, the Canadian dollar is breaking down right here. You had a nice rally from below 70 to around just over 80, and you're coming off, and you've taken out the kind of the support level around 76. The technicals have turned back to the negative side. So we're actually turning bearish right here again on the Canadian dollar. Again, I don't know that I would buy gold in Canadian dollars right here. I think you sell the Canadian dollar and wait to buy the gold on the next dip and kind of leg yourself into a position in gold in Canadian dollars. But you mentioned the currency. Our perspective on this, a lot of our work is currency related. We believe that, this is a massive currency war that's really been going on for a long time, but most specifically since the end of 2013. And when you look at the case of Japan, you have a currency that's breaking out. They don't want it to break out because it works against their goal of achieving reflation. I mean, this is part and parcel to why gold looks so exciting here, is because every central bank in the world outside of the U.S., and the U.S. will come back into play, mark my words, are trying to manipulate policy to keep their currencies from rising or to get them to actually move lower. And as you know, you can't have every currency moving lower unless something's going up against it. And in our view, it's quite clear that something is gold.
Just quickly on that, we got to take a break. But again, when you see these kind of currency wars and the devaluations that have gone on, is that contributing a ton to the volatility we see, or is it just a reflection of that volatility that's underlying that?
Yeah, I think it's kind of both. I mean, it is a reflection of the volatility, but I think more than that, it's a reflection of the level of desperation that you're starting to reach. And again, Japan is a perfect case in point. Japan has been a forerunner in all of these types of policies that central banks have been pursuing. And we think when you have this discussion around perma bonds, permanent bonds, where they keep rolling over potential for a big fiscal expansion beyond what they just announced, which really, they tried to shock the market. I don't think they succeeded. And I think ultimately, when you talk about things like helicopter money, it seems as out of the question to talk about that as it was in 2006 to talk about central banks monetizing government debt and expanding their balance sheet by trillions and trillions of newly printed dollars. That was considered monetary heresy back in 2006, just as much as thinking helicopter money can't happen. And guess what? That happened in 2006, as we know, 2007, 2008, 2009. And I think the setup here is very similar to get central banks to be forced to that precipice where they do whatever they have to continue to try and keep deflation from, maintaining an upper grip here.
I'm talking to Greg Weldon. You can find him at www.weldononline.com, www.weldononline.com. Back with Greg. I'll get a quick overview on stocks and just his general view. I'll go back to the currencies for a second, go back to gold and silver, all of that coming your way. Stay with us on Money Talks. You're listening to Money Talks. Coming up, I got a shocking stat for you that's right down the line of what we're talking about. I got a good goofy award. Victor Adair is chomping at the bit at the trading desk. And Aussie Zurich, are we really seeing the signs of a significant slowdown in the real estate market, especially when you look into Vancouver? He started talking about that about 2 months ago. We've got more data for you. You should pay attention to it. Right now, Greg Weldon is with me. We're talking, we started off talking about gold, and we're going to come back to that in a second, but Greg does a heck of a lot of other things. Greg, can I just do a Barbara Walters on you and get some quick takes on things? Sure. And we'll start with, broad view of stocks.
Well, the broad view of stocks is you really need to narrow the focus to which country you're talking about because you have very divergent action in stock markets. Clearly, the U.S. at new highs. I think you have reached kind of a tipping point in global bonds here where you may see some flow out of bonds into stocks. In the U.S., you had a fairly strong employment report. I mean, you have people moving from not in the labor force into the labor force, finding jobs, second highest number of people that were not in the labor force that found jobs in the month of July in history in the U.S. That's a positive. But what you don't have is wage reflation. Headline numbers notwithstanding, the innards of the wage numbers were the same, sideways at best. And from that perspective, it kind of keeps the Fed on hold. There was no rush to price in Fed tightening off Friday's payroll number in the U.S. And as a result of that, you're kind of in a Goldilocks little spot for U.S. stocks. They break out. You get flow out of bonds. The problem, and I like Canada right here as well, but then you look at other places like Italy, Spain, even Japan. They look terrible. So you have major underperformers. You have some that will outperform. But the problem in the countries that are outperforming, like the U.S., is if you get bond yields to start to rise too much on this kind of flow and the thought process that, maybe the Fed ultimately will be pulling the trigger, I think that stops rallies in stock markets dead in their tracks at some point. You don't have the growth dynamic in the economy necessary to really create another huge bull market for me in stocks. So it's a trade, not an investment, and you have to be very selective.
What market scares you the most right now? I mean, if we can just categorize, stocks, bonds, precious metals, or a particular area. Like I'm worried about the banking system in Europe right now. I think that's a big black cloud overhanging every investment because if it goes into trouble phase, you're going to see a lot of liquidation everywhere.
Well, what scares me is kind of all of the above, frankly, to some degree. But yeah, Europe, you hit on it right on the nail, right on the head here. I mean, what is kind of not talked about, what seemingly has been swept under the rug and completely forgotten about as a major potential landmine out there is sovereign debt. And when you look at Europe, pretty much every country, not every single EU 27 country this applies to, but the ones that are debt offenders continue to be debt offenders at the most, egregious levels ever. Debt is growing there. We know in the U.S. you've gone from $9 trillion to $19+ trillion. Japan is at new highs. I mean, almost all of these countries see new highs in sovereign debt. Now, that's all well and good when you have bond markets that are under control. To me, the scariest kind of market would be the bond market, and that is where you kind of come back around, potentially bring the Fed back into play, get something dramatic out of the ECB or the Bank of Japan, and that brings us full circle all the way back to why ultimately on this next dip, should it take place, you want to be buying gold because central banks are on the verge of kind of losing control of bond markets, and it'll be very interesting to see how far they're willing to go and what they will actually do to try and rein them in down the road, and they're going to have to.
Hey, Greg doesn't know this, but I talked to his office earlier this week because, back in January we had his report on gold and silver, and of course it proved to be so profitable. It's the bottom line. This is a bottom line business, and so he's got a brand new report coming out that if you go to moneytalks.net, you can get it. It's regularly $249 US until Sunday night, midnight. You can get it for $99 US. I didn't say that earlier because I didn't want Greg to hang up on me, actually. But normally $249. You can get it till Sunday midnight at $99. It's the next report on what's coming, looking at that gold and looking at that silver market, which I appreciate, Greg. I'll say thank you now. As I say, I didn't want to say it earlier. You might not talk to me. But we really appreciate that. Also appreciate when you always take time with us here. Let me just finish going back because it's such a big issue for us in Canada, and obviously it relates to the U.S. dollar, but back to the Canadian dollar for a moment. You alluded to the fact that it had to hold 76 cents on the short term, and it didn't. We saw that breakdown, a good cent down actually on Friday before it was sort of dickering around. What are we looking at now, though? Do we start looking at the old lows or just another number?
No, I think you do because you're looking at a macro situation that is soured very quickly in Canada. You were talking earlier about Ozzy being on about the real estate market. You do see signs there, too. I would totally agree with that you've reached a peak and you are in the process of rolling over. And that's been one of the stronger areas in the Canadian economy. And it gets back, too, to the same thing. Again, I can't stress this enough. I mean, the Bank of Canada's balance sheets now, in terms of their assets, is above $100 billion in Canada. And that's a 65% increase from 2011. It's a record high. So from that perspective, when you tie all those things in together, Canadian dollar is very vulnerable here. So I could absolutely see it testing, if not ultimately longer term, breaking those lows below 70 cents.
Greg, it's one of the best things for me doing this show every week is getting to talk to analysts like Greg Weldon. Great stuff as always. I so much appreciate you taking the time with us, Greg.
It's my pleasure, Michael. You do a great job, and I'm always happy to participate and contribute.